Hey guys, welcome back. You're still tuned into MF Corner here on CNBC TV18, and we have with us Swarup Mohanty, CEO of Mirae Investment Managers with us. Swarup, we've been talking about investing, and some of the debates which come up all the time is, should you go active, should you go passive, should you choose an index fund or an ETF? But first on this active passive debate that we always have, my first question is, do you think on large caps you should always go passive? Because, very often that is the space where it's harder to beat the index because of the rules around the, around fund managers and what they can invest into. So do you think for large caps first, passive is always the way to go?
See, Pavitra, first of all, in investing, never fall for cliches.
Yeah.
If you look at last year, the large caps outperformed the benchmark. See, there are two types of approach. One is when you look at active investing, you are aspiring to outperform the market, which is the benchmark, that is the index. Now, along with that outperformance of index comes the risk of underperformance of index. There will be a large pool of investors who will say, I don't want this volatility, let me just catch the market, which is the beta of the market, and hence they invest in passive. When you look at the journey of the index over the last 10, 20 years, it's been good on the return part. Now, it depends on you as an investor. I disagree in India today that any pocket is good or bad for active. As an investor, you are in a great space because there is enough talent in the industry to give alpha beating returns. And last year was a great example on the large cap side. In fact, large cap last year was a bad example for beating index on the mid and small, contrary to flows of the market. So it's better to look at your asset allocation first and then come to this conclusion rather than forming conclusions which the market then proves you wrong.
So that's about, the big debate around passive, active via a particular category. What about index funds versus ETFs? What is your overall take on this entire debate?
See, again, it's up to the investor. There will be enough investors who will say, I don't want to have a demat account. Let me take the index fund. Nothing wrong with that. There are savvy investors who have demat accounts who, for them, they want to trade on the ETFs. Nothing wrong with that. At the end of the day, it's back to the investor. The difference between the two is, as the name says, this is exchange traded. So you are trading on the market at real time, real value. So each to his or her own from a portfolio constructor basis. There is no right or wrong. Now, when you are choosing the both, you have to choose which is the most efficient, which gives you the best INAV in the ETF side, and which gives you good tracking error as a fund. And if those should matter more rather than the choice. If you don't want demat, it's your call. You can take the index, but globally, if you see slowly but surely, the ETFs take over once the maturity of investors.
That's because in US there's a huge tax advantage for ETFs over index funds, which is not there here. But I guess it's beneficial that both options exist here, and you can choose to exercise whichever works for you.
Pavitra, I'm a big fan of options. I'm not that person.
Everything.
Yes,
the menu
there should be choice, no?
Yeah.
See, today, let's understand one fundamental fact that in active investing, because of the categorization of funds, the ideation is limited. We've been told these are the categories, these are the many funds that you can get. But on the passive side, wherever there is an investable universe, you can create an index. And through factors, you can give multiple forms of that index. So ideation is a galore on the passive side. So the number of ideas that can be formed that side will be very exciting. And watch that space in India. So if one were to form a portfolio, a mix of both on the merits of each can give you a better portfolio rather than get stuck in this debate of whether it's active. It is not active versus passive in India. It is a great time as an investor to mix the both and find a better solution to your investment goal. You're so lucky that you have great talent who are giving you alpha beating returns, and you have great ideas which can give you very different, like say just speaking, talking about our product, there's an Alpha 30, which aspires to give you better returns than that. There are enough low-vol products in the market which gives you a risk-adjusted return. There are quality products which can not be replicated on the active side. So we came out with a manufacturing index because it's the birth of manufacturing in India. For the next 15 years, we believe that only manufacturing can give you good returns from if you want to catch something very early, not only, but if you want to catch something very early. So these ideation are large there. So if you mix everything, the portfolio can be far stronger is my submission.
Yeah, it should be a great mix. You know, we don't have much time, but I have to ask you this because we've been talking about SIP investing the way to go. I've just done a dipstick survey and I realized people thought that lump sum investing makes more sense. Markets come down, that's when we'll do a lump sum investment in mutual funds. What's your take here?
See, Sonal, it's a very interesting question and people dislike it when I give this part as an answer. SIP is a cash flow solution. I'm a salaried individual, this is the amount of money, and hence I invest and participate every month. This is a fantastic way of investing as a cash flow solution. Now, breaking lump sum in a staggered manner in any form is timing of the market. Let's face it, I can give a lot of logic as to why I'm breaking it. But once you start breaking your investment, you're actually banking that the market should come down. If you look at the last 2 years, more often than not, your SIP is actually catching higher NAV. Now, if there is volatility, the Rufi cost averaging comes in and that's great. But the best time to buy is when you have the money. So when you are hiring a manager, I will repeat again, let the manager do that thing. And when you have the money, just give it. Don't, in India, when you're going from 3.5 to 6.5 trillion, the sooner you invest, the compounding starts then. Please do not delay investing in this market if you're a 10, 20-year investor. In the long term, you know, it doesn't matter much.
The cost of delay is much.
The more money you have at this moment, the closer you are to your allocation, the results will be better. So I am not a big fan of breaking my lump sum into staggered investing. I never time market. So when I have the money, I invest. And that's what one should do.
And there have been enough sort of, surveys and research to show that if you just get in earlier, it is going to probably give you higher returns
absolutely.
also.
Absolutely. Your compounding starts then. Now, on 12 months, you will pray that the market comes down a bit. Out of 12 installments, if you are catching two lows, your 10 are actually an high in a bull market. So you have to, if you have taken that call, you have to assess whether that call is right or wrong, is my submission.
Yeah.
Okay, take that point. Thank you so much for joining us today on this Diwali special. And you know, it's always good to start with the basics and keep revising them as well, right? So wishing you and everyone at the family and Mirae Group a very, very happy Diwali. With that, we'll take your leave on this edition, but stay tuned. More and updates follow on the other side.